ICAI, sum number 4, May 2022. This was asked for 10 marks. Excellent question for cost of capital. Company issues 15% convertible debentures of rupees 100 each at par with a maturity period of 6 years. On maturity, each debentures will be converted into 2 equity shares of the company. The risk-free rate of return is 10%. The market risk premium is 18%. And beta of the company is 1.25. The company has paid a dividend of 12.76 per share. 5 years ago, it paid a dividend of rupees 10 per share. Flotation cost is 5% of issue amount. Second point is 5% preference shares of rupees 100 each at a premium of 10%. These shares are redeemable after 10 years at par. Flotation cost is 6% of the issue amount. Assuming corporate tax rate of 40%, calculate the cost of convertible debentures using approximation method, YTM method to calculate cost of preference shares. So both methods are covered under this question. Also, the concept of time value of money, valuation of security, each and everything is covered as far as this question of cost of capital is concerned. Let us start with first point, that is cost of debentures. 15% convertible debentures of rupees 100 each at par with a maturity period of 6 years. On maturity, each debentures will be converted into 2 equity shares. So debentures after 6 years will be converted into 2 equity shares. So the problem is this: what is my redemption value? After 6 years, as a company, I am not paying money to my debenture holders. What I am paying is 2 equity shares. So here I will have to value 2 equity shares, but not as on today, after 6 years. So I want market value, or the value, I should not write down market value, value of 2 equity shares after 6 years. What I'll be doing is, I will be taking, how I'll be valuing equity shares. Value of equity shares at the end of 6 years will be is equal to dividend of 7th year upon KE minus G. Infinite cash flow with growth. I have found out valuation of security. How to find out value of anything in finances? Present value of future cash flows. But here I am not taking D1. Why? I don't want value today. I want value after 6 years. So I am taking D7 so that I can get value after 6 years. Now D7 is also not directly given. So I'll have to find out D7. KE is not given. So I'll even have to find out KE. G is also not given. So I'll have to find out G. Let me first start with KE. I am using CAPM method because I am having RF, market risk premium, and beta of the company. %18 is RM minus RF. It is not RM. The risk-free rate of return is 10%. How to find out KE by CAPM? RF plus beta into RM minus RF. What is risk-free rate of return? 10%. Plus beta is 1.25. RM minus RF, market risk premium. It is not market rate of return. Market risk premium is RM minus RF is 18%. What will be my answer is 18 into 1.25 plus 10 is 32.5%. What I have got? One variable of my answer, which is KE. Let me go to second one. How to find out growth rate? See what is given. The company has paid a dividend of 12.76. I have told you from the sentence you will have to determine whether it is D0 or D1. Next year dividend paid or expected to be paid is D1. The company has already paid. This is D0, which is 12.76. Also, 5 years ago, it paid a dividend of rupees 10 per share. D minus 5. What is D minus 5? 5 years ago, the company has paid a dividend of rupees 10 per share. Try to concentrate. The dividend of rupees 10 has increased by I rate of return for the period of 5 years, and I have got dividend of 12.76 after 5 years. It is a simple formula for future value. P into 1 plus I raised to n is equal to amount. This is amount. This is P into 1 plus I raised to n. But here I don't know I. So 1 plus I raised to 5 is equal to 12.76 divided by 10, which is 1.276. So practically I need to find out this. 1 plus I raised to 5 is 1.276. What is this I? What is this rate of interest? Try to concentrate. It is very simple. 1 rupee is becoming 1.276 after 5 years. 1 rupee is becoming 1.276 after 5 years. What is the rate of growth, or what is the growth rate? Now, normally you can do trial and error in your calculator, but for this specific question, some of the factors are given to us. Future value interest factor, future value interest factor, future value interest factor. For 5 years, for 6 years, for 7 years. I am interested in 5 years. 1 rupee at 1% after 5 years will become 1.051. 1 rupee at 5% for 5 years will become 1.276. What was our answer? 1.276. What does it mean? I is 0.05. That is nothing but growth rate is 5%. Sir, if this table was not given, then in my calculator I'll try out 1 plus 3% plus 3% plus 3% plus 3% plus 3% for 5 years. I'll see whether the answer is matching with 1.276 or not. If the answer is lower, I'll try it with 4%, then I'll try it with 5%, and ultimately in my calculator also, I will get an idea that 1 rupee will become after 5 years at 5% rate of interest, 1.276. So growth rate also I have got the answer, which is 5%. Alright. I need answer of D7. I am having answer of D0? Yes. I can easily find out answer of D7. D7 is equal to D0 into growth rate for 7 years. That is D0 is 12.76, 1.05, 5% raised to 7. 1.05 multiplied by is equal to, this is 2 times 3, 4, 5, 6, 7 multiplied by 12.76. This is 17.95. This is nothing but answer of D7. This can also be found out from our table. 7 years at 5% rate of return. How much 1 rupee will become is 1.407. This answer 1.407. 1.407 multiplied by 12.76. I'll be getting same answer, that is 17.95. I have got D7. I can find out value of the share after 6 years. I am having all the variable D7 upon KE minus G, which is nothing but 17.95 upon KE. What is KE? 32.5% minus 5%. This is 27.5%. Answer will be 17.95 divided by 0.275. That is 65.27. Per share is value of this company's shares at the end of 6th year. Now I am going to find out cost of debentures. How to find out cost of redeemable debentures? It is I into 1 minus T plus RV minus B upon N upon RV plus B upon 2. Let me first find out all the variables. Interest rate. They are 15% convertible debentures of rupees 100 each at par. So face value is 100 into 15%, that is rupees 15 will be nothing but I. Tax rate I am knowing it. Tax rate is 40%. 6 years, N is 6 years. Each debentures will be converted into 2 equity shares. The risk-free rate of return is so and so 5 years ago. Flotation cost is 5% of issue amount. So borrowings will change. It is 100 minus 5% flotation cost is rupees 95. And I need to find out the redemption value. What is redemption value? At the end of 6 years, how much money you are going to pay to one debenture holder? How much you are going to pay? You are not going to pay money, but you are going to pay 2 shares. After 6 years, I am knowing the value after 6 years. It is 65.27. How much total value you will be paying them? 65.27 multiplied by 2, that is 130.54. So I am paying 2 debenture holders after 6 years, practically 130.54 in form of 2 shares. I can find out cost of redeemable debentures. 15 into 1 minus 0.40. Redemption value is 130.54 minus borrowing is 95 divided by 6 upon 130.54 plus 95 divided by 2. First, let me find out denominator. It is 112.77. Numerator, this will be 9 rupees plus 130.54 minus 95 divided by 6 plus 9, 14.923 is numerator. Multiplied by 100, I will be getting cost of debentures. This is 13.23. This is nothing but cost of redeemable debentures. Excellent question, because this was not directly given. They told we are going to give 2 shares after 6 years. Neither KE was given, neither D7 was given, neither G was given. All we found out, and then we got the answer of cost of redeemable debentures. Second part of the question is also excellent, because we need to use YTM method to calculate cost of preference shares. They are 5% preference shares of rupees 100 each at a premium of 10%. These shares are redeemable after 10 years at par. Flotation cost is 6% of the issue amount. All right. So I have taught you YTM method. Please understand, to make it easy, I will think I am investor in this preference shares, and I will find out what is my IRR. How much actual rate of return I am earning from this preference shares, which will be equal to cost for the company. Whatever the investor is earning is nothing but cost for the company. And if you know the concept of IRR in capital budgeting, again, this is very easy. But first we need to find out cash flows. If you are investor, I'll deduct my flotation cost. Whatever the company is getting is nothing but whatever I am paying. So what is the borrowings? Borrowings will be 100 plus 10 is 110 minus 6%. At the end of 0 year, what company will be getting is I am paying 110 minus 6%. Let me directly do it. That is 103.4. This will be cash inflow for the company. This will be cash outflow for the investors. Investors actually does not, they also bear the flotation cost. Actually, the cash outflow for investor would be 110. But as we are finding out cost of capital for the company, please understand we are just changing the sign. The negative, we are making it positive, and positive we are making it negative. This is actually cash inflow for the company. We are writing it cash outflow because we have found out how to find out IRR in our capital budgeting chapter. From 1 to 10 years, what will be cash outflow for the company will be cash inflow for the investor. So I will be writing down positive figure, which will be nothing but 5% preference shares, that is 5 rupees every year. And at the end of 10th year, how much amount will be repaid back? 100 rupees. So please understand, from the point of view of investor, I am just changing the sign. You will have to think from the point of view of company and then just change this sign. So let me write down this. From the point of view of company, but just change the sign. This would be a better interpretation for this. This is cash inflow for the company, but I have written negative. This is cash outflow for the company, but I have written it as positive. I am finding out NPV at the rate of 3%. So this will remain 103.4. This, how to find out the present value of annuity for the period of 10 years at 3% rate of return. I can directly multiply the factor which might be given in my answer. At the rate of 3% for the period of 10 years, I want annuity. I don't want present value interest factor. I want annuity. So I can take directly this 8.530. 8.530. What is this? This is total of 1 divided by 1.10 raised to 1 plus 1 divided by 1.10 raised to 2 up till 1 divided by 1.10 raised to 10. So this is direct factor, which is nothing but 8.530 530 multiplied by 42.65. This cash flow is not for 1 to 10 years. This cash flow is only of 10th year. So which factor will be multiplied is this. I will not multiply present value interest annuity factor. I will be multiplying present value interest factor, which is 0.744. And it should be at the rate of 3%. Yes, I am doing at the rate of 3%. Which will be 74.4. $74.40 plus 42.65 minus 103.4. It is 13.65. Positive. This project is earning more than 3% rate of return. Let me find out NPV at 5%. This is going to remain 103.4. This is going to become 5 into. Now I'll have to take rate of return annuity factor for 5% and not for 3%, which is 7.722. This will be 5 into 7.722. 38.61. And this will be 100 into present value interest factor, but for 5% and not for 3%, which will be this figure, 0.614, which is 61.40. Now, how I thought of taking this as 3% and this as 5%, because this interest factors are given, 3% and 5% is given. So I'm much confident that I'll be getting one positive figure, one negative figure, and I'll be easily getting the range. 38.61 plus 61.40 minus 103.4, which is minus 3.39. The project is earning more than 3%. The project is earning less than 5%. One positive NPV, one negative NPV. We can use our formula of interpolation and get idea how much IRR will be there, which will be nothing but cost for the company, where cost of preference shares will be is equal to base rate. Let me change the color. Base rate plus positive NPV upon difference in NPV multiplied by difference in rate. Base rate I'll be taking 3% plus positive NPV is 13.65. Difference in NPV is 13.65 minus 3.39. That is plus 3.39. 17.04. Difference in rate is 2%. This will be 13.65 divided by 17.04 multiplied by 2 plus 3. It is 4.60. This is nothing but cost of preference shares by YTM method. And once again revising YTM method, write down cash flows for the company, just change the sign. Why I am changing the sign? Because I have done IRR in the chapter of capital budgeting, so that the same formula I can use over here. I am changing the sign. There is no other reason. You can keep this as positive, this as negative. Just somewhat change the formula, you will be getting the answer. But I don't want to change the formula, so I just changed the sign. I am doing it from the point of view of investor. But what you should do from the point of view of the company, just change the sign so that directly this can be used. Otherwise, see, here you will have to take negative NPV. From the point of view of the company, positive will become negative, negative will become positive in cash flow. Find out IRR. Your IRR is nothing but your cost. In this case, cost of preference shares. One of the excellent 10 marks question which was asked in May 2022, 10 marks for cost of capital.